morning, Sandeep, and thanks so much for speaking with us here at Moneycontrol. Let me start off first with a broader perspective. Right now, if you look at the markets, they seem pretty volatile and there aren't really those big triggers. Yes, we of course know we are sitting in an election year. We have the interim budget in barely weeks from now. So all of those already factored in, one would say, to how the markets are behaving. But are there any kind of headwinds or even tailwinds that could then swing the direction of the markets according to you?
Hi, good morning, Stacy. Thank you for having me here. See, I think globally they are fairly mixed signals. The people are expecting, analysts are expecting that in the US there could be an early rate cutting cycle because they are expecting a shallow recession. And recession normally is not great news. That means the economy is slowing down, and the central bank could be cutting rates to support the economy and the investment and consumption. So globally, I don't think that things are great from a macroeconomic perspective. The only thing which is very pushing the markets up, I think, is a global influx of liquidity which has been in the system, and it has been moving from markets to markets, and it has been pushing up prices wherever there is a potential of growth or where there is some undervaluation. And I think Indian markets are no different. We are experiencing good growth in the Indian economy compared to the global economies, and which is why our valuations are going up, and they are being spurred by the local investments who are coming due to the increase in the prices. And besides global liquidity, which central banks are calibrating to remove gradually because global liquidity has long-term impact on inflation and inflationary expectations. The other important thing I would like to highlight is that because of the increasing asset prices, there is a perceptible change in the wealth effect, and that wealth effect can lead to high amount of conspicuous consumption and speculation in financial markets, and that is feeding into the markets as well. So globally, I don't think that there is any great news that we can expect.
Right. So globally, no big triggers, and the ones domestically, at least, we're kind of already factored in. But like you were talking about, so much of liquidity, and that's perhaps where we saw the valuations, at least in India, being quite, expensive, one would say. But do you think the market is yet to be overstretched in terms of these valuations? Because we've seen almost a 15% rally since October from those lows in October. So how do we really navigate this? Or how do we look at whether this inflow or outflux that we're going to see, what is really going to be the one attracting it?
So I think the volatility can be, overcome by increasing your investment horizon. So I don't think that the basic rules of fundamental investing can be wished away, and you can keep taking the valuations higher and higher just because of momentum and liquidity. I think if one wants to invest, one should invest with professional fund managers who have the ability to judge and time the markets probably. And they will also help you in terms of picking out the wheat from the chaff. So I think it is very important at this point of time to be cautious and invest with professional fund managers and really think in terms of long-term holdings. So one has to increase the long-term holding horizons, because the volatility at the shorter end could be quite painful, and it could lead to disappointment in the short term. There is no real measure for us to tell how far the valuations can go. But given the economic parameters, the interest rates, the inflation, the growth, the valuations definitely are stretched. And then, which is why one has to really think slightly long term when they're investing in equities at this level.
Right. So it's a long-term play, at least if somebody is looking at equities as an investment bet. But let's also focus on the sectors that could really be helping the market overall. And let's put focus on the FMCG companies, at least, because so far they have not really had those kind of triggers, at least if it comes to their volume growth or the rest. Now, if you look at HUL, they're going to come out with its earnings tomorrow, and the profit is likely to remain quite flat. At least most of the brokerages putting that out right now. Also, the volume growth still a bit weak, and we're not seeing that pickup in a rural demand like we were anticipating. So could we see the budget really change things from here on, at least for the FMCG pack? And what would be your picks in the consumer discretionary sector overall?
Also, we won't really want to comment on individual sectors or companies, but one thing is very clear that the capital expenditure that government has undertaken has led to some amount of pickup in investment spending. Although the capacity utilization has been quite strong, but I don't see any major capital outlay from the private sector. And when we speak to banks also, there's some amount of increase in capital expenditure and borrowings against capex. But this could be maintenance capex and not really fresh capex. So I don't think that capex cycle is going to really take off immediately. And I think government will be looking to reduce their government spending, at least in percentage terms, because there are concerns on the fiscal side as well. So I don't think government can do the heavy lifting beyond a certain point. And this budget could be a point where the markets will get to know that one cannot expect government to indefinitely start to keep spending on the capital side. Government's business is not to keep spending and keep investing in manufacturing or in industry. Government's job is primarily to govern. So the idea of government spending on the capital side was to kickstart the economy and the investment cycle, which if the private sector is not willing to take up, I think government will also have to take a step back.
Right. So maybe we might see some bit of, outlays being increased, but not as per how much we would want. Also, this is an interim budget, so perhaps not that much action that we could anticipate there. But let me finally also get your view, Sandeep, then on, which would rather be, right now what we're seeing the markets do at least is telling one to just sit back, take a look, rather reassess how one should be looking at. And in a portfolio building strategy, how would you then prepare one? Would you now look at large caps because that's where we saw, the bounce back coming in, or should you still look at mid and small caps because they can still, really take you forward, even if we do see some major cuts like what we witnessed yesterday? Maybe the mid and small caps might have some bit of relief then.
So Stacy, I think one should have a very good asset allocation and one should stick to it and only deviate from it only for a temporary basis. So I think anybody should have 50 to 60% in income-bearing assets, which will keep the portfolio value stable. And if you have 40% left, then 25% should be in large caps. See, we must understand that most of the economy, the profits are generated by large caps. Our perception about small and mid caps can change, but the reality or the ground level will not change as rapidly as the perception. So one can be taken by surprise by the rally in mid and small caps, but one can be assured that things will not change overnight and the fundamentals will take time to catch up. On purely valuation basis, the large caps look definitely far more attractive on a relative basis. I am not saying that large caps are looking attractive on an absolute basis, but on relative basis, if one has to allocate more money to equities, then the allocation should definitely be towards large caps, and large caps should perform over a period of time is this rally to continue. So I think at this point of time, if you ask me where should one allocate money, if one were to allocate money in equities, I think the lion's share should go to large caps.
It would be wise maybe to still keep or hold on if you do have some of those heavyweight names in your portfolio. Large caps in the long run should be able to deliver. At least that's Sandeep Bagla is telling our viewers. But Sandeep, finally, any kind of sectors as well as stocks. You did say that you wouldn't speak stock specific, but any kind of sectors that we need to be watching out for that could really be, a turnaround, be it IT or the banking, stocks that we saw pretty much be the underperformers last time around. Could we see some kind of change this time if you look at from the long-term perspective?
No, if there's money flow, then there will be sectoral rotation, right? On something will become relatively cheaper than others. There is some buzz that, the defense sector could open up, railways could open up. But I think one has to really wait, invest small amounts and wait for the numbers to actually come in. So I think one should have a balanced portfolio, and I do not want to overemphasize the importance of staying with experienced fund managers whom you can employ for as low as 1 or 2%. So I think one should stay with the professional fund managers.
That would be the strategy then, but if there is money coming in, rather park them in the large caps at least. Let me thank Sandeep Bagla there of Trust Mutual Fund for giving us his time this morning and helping us understand how one should really be navigating the current market scenario that we sit in. Thanks so much, Sandeep, for your time.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.